The U.S. economy is trapped in a finance-first model that undermines its own industrial base. 1. Wall Street wins, Main Street pays the price. Financial markets thrive on speculation and liquidity, often at the expense of real economic growth. Policies that prioritize asset prices over wages and productivity have gutted American industry, offshoring jobs, and hollowing out manufacturing. The obsession with short-term stock performance fuels buybacks and financial engineering, while real investment in production and innovation takes a back seat. How did we get here? Corporations chased higher profits by offshoring production, cutting labor costs, and prioritizing shareholder returns over long-term growth. Wall Street cheered them on, rewarding stock buybacks and financial tricks instead of real investment. Meanwhile, corporate lobbying ensured that monetary policy stayed in their favor. Cheap debt, endless liquidity, and a Federal Reserve more focused on propping up markets than strengthening the real economy. The result? A finance-first system that enriches the few while eroding the industrial backbone of the nation. The only way forward: compete where it counts. Decades of offshoring have hollowed out Middle America, widened the wealth gap, and contributed to a staggering $36 trillion national debt. Now Trump aims to reverse course, implementing tariffs, reshoring, and onshoring supply chains. But this isn't pre-2001, before China joined the WTO and reshaped global manufacturing. America can't compete with China on low-cost mass production. The path forward lies in high-end industries like EVs, semiconductors, and advanced robotics. This necessitates significant investment in R&D, workforce training, and automation to rebuild an industrial base that's not just made in America, but leads the world in innovation and productivity. 4. America must thread the needle or crash into a brick wall. The U.S. stands at a crossroads: adapt or face economic irrelevance. Competing with China and BRICS isn't about retreating into tariffs alone. It's about strategic engagement. Both Federal Reserve monetary policy and Treasury fiscal policy must align to drive a new industrial revolution. This means marshaling national resources into a clear endgame, reclaiming global leadership through innovation, production, and self-sufficiency. Here's what it takes to win. Interest rate and credit realignment. Incentivize investment in industry, not just financial speculation. Targeted industrial policy. Prioritize R&D, high-tech manufacturing, and domestic energy independence. Workforce overhaul. Train Americans for AI, robotics, semiconductor production, and advanced engineering. Automation and productivity. Scale up robotics and advanced manufacturing to compete on efficiency, not low wages. Supply chain sovereignty. Secure critical materials and infrastructure, reducing dependence on China. Strategic trade and tariffs. Use selective tariffs to protect key industries while maintaining global competitiveness. This isn't a return to the past, it's a leap into the future. America must invest, innovate, and execute, or get left behind in a world reshaped by BRICS and China's dominance.